Hey, good afternoon once again to all of our market rebels and our options traders out there in YouTube. It's great having you here. And today we have back with us Scott Thorstensen. Welcome.
Thanks, Bill. Good to be here.
Yeah, it looks like you're a little bit cool up where you are, huh? I heard you're like in the 30s or something.
Yeah, 35, 34.
Get to be that. I think
Scott, you live in Utah? Is that where you are?
Salt Lake City, yeah.
Salt Lake
City. There you go.
Yeah, you're kind of in stew temperatures up there. But today, kind of flat today. I think I didn't see the actual close, but I think the Qs were about flat, SPY up maybe a touch. But I think we had about, what is it, 5 or 6 straight days now of green candles, it looks like.
Yeah, I think 5 days, green candles.
5, yeah. So it's looking good. But this is a perfect time to talk about this. I know we've been talking about it, Stu, in our Q&A, where at least for right now, it looks like we're temporarily out of some of the inflation fears, definitely out of the COVID fears. And it's now a time where people might start entertaining the idea for stock replacement or getting into stocks. And so we thought it's one of our favorite strategies. I know we try not to use that phrase, but it's a very popular one. And it's one that we use a lot. I know you guys coach on it a lot. We talk a lot about in Q&A. So we thought, let's go ahead and share it with all of our traders out there and on YouTube, just the basics of stock replacement. And the thing that you really want to key in here is how it's not really it's a different use of options, because we're getting away from it behaving like an option and more like shares of stock. And it really is kind of throws a lot of traders when they see this for the first time. So let's go ahead and get started with today's presentation. And here's our Chalk Talk. So again, anybody who's new, Chalk Talk is a little thought-provoking question to get us started. We'll answer it at the end. But we've got the stock at 180, and we've got the $140 call trading for $42. And the question is, or the statement, this is an expensive option. So the question we have, is that true or false? Now, most people look at that and say,
looks a little pricey to me.
Look at that, $42, man. Most of the time when we talk about options, we're talking about 50 cents, buck, couple of bucks, $3. But 42 is I would think that's going to be an expensive option. But hold that thought, and we're going to come back and revisit it. And so to answer that, let's take a look at our topic here, which is stock replacement. And I just realized I have to get the where did the there it goes. Okay, so for stock replacement strategy, this is again one of our major uses for the times that you really want it to be a delta play, where we're trading direction.
I got a quick thought here. Let's just for 5 seconds here. Just go back to that question. To the Chalk Talk question. Yeah, true or false. Yeah. All right. So look at that, everyone. And then say, well, how about if the 140 call was 39? And then ask the same question. And then make the same statement. This is an expensive option. Ask the same question. See what you come up with. All right, go ahead.
Yeah, that's a good one. All right, so we're going to talk about the stock replacement strategy. It's a use of options. It's also to show how versatile options are, because we can buy them at the money, in the money, out of the money, and there's reasons for it. And this is just an extreme use of one of those uses. And we call it the stock replacement strategy because it's a way to use an option as a way to mimic shares of stock. In other words, as a stock substitute. So let's take a little bit closer look at what this strategy is all about. And before we do, again, for anybody who's new, please visit us at marketrebellion.com/get started. So we have a ton of great information, videos, things to help you get started with your options trading. So stock replacement It's leans more on the conservative side of use of options. Normally we hear that options are really high risk and for, the gunslingers and people that are just out there speculating. And that is absolutely not true. They can be used in that way, but this is actually going to an extreme use in the other direction. And we'll show you why it's really more of a conservative use. And the basic idea is that you are going to buy a deep in the money call. How deep? Roughly for right now, this part of the conversation, 85 deltas or higher would at least get you in the ballpark.
I would put, and if it were me and I was doing this, I would say 85 and I would put ISH on it. Ish.
Yeah, exactly. Because there could be times that for whatever reason, we want to go a little bit less, a little bit more, and you'll find out why later on in the presentation. But the basic idea with this 85 delta range is that you're going to have very little extrinsic value or time value, and you will have a lot of intrinsic value. And because you have very little extrinsic value, you also have very small amounts of time decay. And this is, again, where people get thrown with this strategy. They think it's got large time decay, and it's just the opposite. There's almost none. So by going deep in the money, let's say, again, roughly this 85 delta range, it's going to behave almost like shares of stock. But we have to go so far in the money, it's something that most traders would never think to do. So let's look at an example. Let's say the stock is at 100 and we have the $80 call trading for 21. All right, so there's $20 of intrinsic and $1 worth of extrinsic or time value. So we've got 20 intrinsic, extrinsic is $1. This is what you want to keep your eye on.
Intrinsic's the difference between the stock and the strike price. Right?
Exactly.
So 80 minus 100 is 20.
Right.
Yeah.
We have the right to pay 80 with the call, even though the stock's trading at 100. So you could ask yourself, is there a benefit in being able to pay 80 instead of the current market price of 100? Oh, yeah. How big is the benefit? 20.
$20.
That's what we might call the cash value, that we could definitely pull $20 out of this option. We could exercise it, turn right around, pay 80, turn right around and sell the stock for 100 and pull $20 out of it. That's a way to consider or understand what the intrinsic value is. But we have to pay more than that. How much more? Just $1. So our break-even price, we can always find by taking the strike 80 plus the price of 21, or what we call the option premium, the total price. 80 plus 21 is 101. So if the stock is at 101 at expiration, you would just break even. But take a look. That's only $1 more than the current stock price. And see, a lot of people look at that and say, man, it's a $21 option.
Yeah, but Bill, why would I pay $1 more when I don't have to?
Good. Hold that thought for a second. We're going to get there, because that's another reason why people will kind of shy away from the strategy. Why would I pay more?
Why would I pay more?
Why would I pay more than the intrinsic value? Well, one advantage right now that we can see is we're paying roughly 1/5 of the stock price. I
like that.
Yeah, I'm paying, let's call it roughly $20, or 1/5 as opposed to 100. And as we're going to show, this is going to behave almost like shares of stock.
Bill, can I take the $80 and put it into a risk-free return?
The 80, you mean the 80 that you didn't
money
spend
I'm not
on
spending.
there? Oh, absolutely you could. Yeah.
That's key. That's key.
One of the advantages is that we are becoming more cash efficient, that we don't have to spend 100, we can spend 21. We can park the remaining $80 into a money market, let it sit there. So there's all kinds of benefits in being able to spread the cash smoother. So the other thing is we're going to get no margin interest and no margin calls. Now, even if you can go out on margin, the very best you're going to do is 4-to-1, but you got to be out by the close of business. This could be a 1-year option. And we're going to go, I have no fear of margin interest or margin calls.
Yeah, I'm not interested. I want to kind of do this for a while. I want to be an investor. I'm not interested in getting in and out today. I want to use this as a tool to invest with.
Right. Try to get 4-to-1 or 5-to-1 and pay no margin interest or avoid margin calls. Can't be done.
Yeah, and if you can
But
figure out how to do that, can you let me know?
Well,
Without
we're going to
being
talk about it. It's right here.
professional and
Stock
portfolio
replacement.
margin.
Yeah, there we go. So now let's take a little closer look at what's going on here. We're going to compare two traders. So let's say we'll put Stu and Scotty. Let's say that Stu is going to buy the stock that's currently trading at 100, and if it drops to 80, what happens?
Oof.
Stu is down $20.
Yes, I am.
But let's say that Scotty buys the $80 call. All right,
The
now
80
that
strikers.
option
Yep.
expires worthless, right? He's got the right to pay 80, but we're right at that strike at expiration. How much is he down? He's down 21.
I'm glad you gave me the leverage of the option, Bill. I'll
See,
take that.
exactly. So already
Yeah.
we're starting to see that this is where people start to misinterpret the strategy. They'll
See,
say,
Scotty, in this case, Scotty didn't even. I mean, it looks like he's actually down $1, but if he's being cash efficient, he's not even really down $1 because he really should have taken that money and put it into a money market at 5.25%, and maybe
even be ahead.
30 or 40 cents on it, and he's actually down 60 cents.
Yep. But the problem is, here's the first and the biggest misperception that traders have. They'll look at this and they'll say, I lost 100% on my option. Whereas if I had bought the stock like Stu, I would only be down 20% and I could continue holding.
Yeah.
And as we're going to find out, that's a complete misperception. If Scotty wants to come in here and buy the stock right now at 80, he could go out and buy the stock in the open market at 80, and his cost basis would be 101. Be exactly the same. See, but people think that just because your option expired worthless, that somehow the whole game is done. And they're just not. But now take a look at this. If Stu is still holding the shares of stock, he's faced with potential continued losses. He's still Delta 1. And Scotty is capped. It doesn't matter if that stock continues to slide all the way to zero. Scotty is limited at 21.
You mean the option can't go below zero?
Cannot go below the price that the price that you paid, right? The option itself cannot go below zero, right? So here's the thing, the first and probably the biggest part to understand about this presentation and this strategy is that if you want to buy the stock, you really have two choices. You can either buy the stock or you could buy an option. But by buying this option, he's really not that much worse off than Stu. He's only worse off by $1. But see, people, they don't look at that. They don't consider the alternatives. They go, oh, I just bought this call for 21. It expired worthless, and I lost 100%. I'm never going to buy options again. They don't realize that the only other choice they had was to buy the stock, and the stock trader's down 20. They're just worse off by $1. Where's that dollar coming from, Stu?
Well, it's coming out of my pocket, and I think I'm going to call it insurance premiums.
Which was the extrinsic value.
So, and I know everybody's probably asking this question. They're saying, well, yeah, but if I expire worthless, I'm done. And Bill alluded to that just for a moment. I'm going to expand on it just for another moment. You're not done unless you decide you want to be done.
Correct. Right? You can always get back in.
You're done when you're done. If you want to do it again, would you now buy can you now buy another option? Sure, you can.
Sure, you can do another stock replacement.
No, you're going to buy the new high delta option. Maybe you'll buy the 60 call or the 65 call, and you're just going to watch and repeat, and you're kind of do it again. And you'll pay another premium, right? You're going to pay another premium, but that's the money that you're paying to avoid, like what Bill's talking about here, the extra money you're about to talk about it. I'm not really sure where we are, but if that stock keeps going down and I'm the stockholder, I'm bagged. Whereas if I'm the option holder, I'm capped. And that's a good thing. That's why they call it insurance.
And that's the reason. That's one of the ways to understand that additional dollar that we talked about is right here. Scotty cannot lose more than 21. See, Stu cannot make that claim. The moment he bought that stock, even if he uses stop orders, even if he watches it closely, all the other things that we hear, he cannot stop that stock from falling more than 20. The option absolutely will.
Can really hose you too, by the way.
It can.
Right? That stock, you can have a market stop and the stock opens at 60 and it'll trade down there.
Or it's a stop limit and it doesn't trade at all. Now you've got an unrealized loss of 30 or $40. Right. You can't avoid it. The option is an insurance policy. So the first thing to understand here, again, is that you can either buy the stock or you can buy the option. But what we're doing here is we were making this option so deep in the money that the additional value is very low. The insurance policy is low. So this is what it looks like graphically. There is Stu on that black line, dollar for dollar up, dollar for dollar down.
Right, I'm the stock owner.
Yep, he's the stock owner. If the stock is right here at 100 on that dotted line, here's Scotty on the red line. That's the $80 call trading at 21. So this is an actual Black-Scholes graph of showing the way that Scotty's position would behave now. So notice that right now where the stock is, Stu and Scotty are operating up in this range. All right, you can see there's very little difference between the black and the red line. Let's call it between 90 and higher. And that's another reason to understand why it's called stock replacement. Both Scotty and Stu have roughly this straight line dollar for dollar up and dollar for dollar down. The difference is Scotty's dollar for dollar down only lasts until about 90, and then he starts leveling off.
Yeah,
he
the
goes to a
mimicking
maximum
quality
loss.
Actually, it gets closer to an even 1-to-1 the farther it goes up. But on the way down, it kind of goes the other way, right? They move
Right.
apart, and that's the part that becomes the hedge.
That's the hedge. And that's another reason graphically to understand why you're paying the dollar.
Yeah.
Is it's giving you the ability to limit those losses or to start, as I always say, hitting the brakes. It's decelerating those losses, whereas Stu is dollar for dollar always. Okay, so that's another way to understand the benefit. We're just going so deep in the money that we're operating in this portion of the risk graph. And so it's pretty much like shares of stock. Again, look at that. You cannot tell much of a difference between the stock and the option in this range,
Only
right?
$1.
That's it.
I'll take an unlimited gain with a limited loss.
You've got unlimited gains but a limited loss of 21. Stu has unlimited gains, but also an unlimited loss, at least down to 0. So now sometimes people say, and Stu, you mentioned this earlier, but why would you pay anything over the intrinsic at all? Why did we even pay the buck? Well, here's one reason. Again, we have this braking system, let's call it. But there's another reason. And I like to use, this is my go-to example for this. Let's say that we're at a horse track and everybody else has to place their bets at the starting line.
Bill,
Right,
is that you, the third horse in the middle?
It is not, but it does look like Roscoe's ears. And let's say that at some point we say, I want to bet on horse number 4. All right, well, we have limited information at this point. Doesn't matter what they've done in the past. Horses can pretty much do anything they want once that gate drops. So here's the difference. Would you consider it an advantage if Scotty, let's say if he had a deal with the racetrack owner, it says, I'll tell you what, Scotty, I'll let you place your bets for the same odds once the horses are halfway around the track. Would that be an advantage? What do you think?
Scotty?
Do we lose him?
Oh, yes, absolutely. That's an advantage. That's never happened to me at the horse track. I wish it would.
And it's not going to happen, but if it did happen, yeah, it would be a huge advantage. And in the financial markets, we have to pay for advantages. And that's really what the option allows you to do, because with the option, we get to wait and see if this is our horse down here. I guess it looks like that's number 4 right there. And he's coming up dead last. We might say, you know what? I'm not going to exercise this option. I'm going to pass. I'm going to let it expire worthless.
Right. And that's your dollar. That's what you paid $1 for.
Yeah. So you're going, okay, it is an advantage. And that's what the call option allows you to wait and see how the stock is going to unfold in the future. Whether you want to call that a week, 6 months, 3 years, you get to wait and see. So ask yourself.
Let me get this right, Bill. So I can pay $100 now, or I can pay $20 now plus a little bit of a fee and kind of wait and see what happens. Is that what you're saying?
You can, correct. And you can always decide to exercise and pay the balance by that strike price. So in this example, if Scotty paid 21 for the call, he can always exercise and pay 80, in which case he's out 101 instead of 100. But he's not out 21. That was just a down payment of the intrinsic value. So yes, you get to wait and see how that stock is going to unfold. Ask yourself, is that a benefit? Obviously, yes.
I think it's
Well,
a benefit. I don't know about anybody else.
And therefore you have to pay for it. And that's the best way to understand that extrinsic value. So we all often talk about, for a call option, or for put options for that matter, it's the right to walk
Yeah.
away.
This is exactly what we're talking about.
The
right
call
to
buyer isn't required to buy
Right.
the shares.
Right. You can if you choose to, but you're
You
not
can.
required to.
Not required to. It's an insurance policy.
It's a
So see,
right.
that's different from the stock trade. When we, back to my example, when Stu bought the shares, the very second he bought those shares, 3 months later, he can't, the stock gap's down to 80. He can't say, I've decided I don't want them.
Well,
They're
I could,
his.
but the broker would tell me to pounce in.
He's right. You can't DK that. They're going to say, no, you bought it.
No.
It's an insurance policy. Well, now we have to take the next step and say, how much is the insurance worth? And one of the best ways to understand this and to understand the stock replacement strategy is to think of the word confidence. We're going to show you a little bit of option pricing theory here from a different angle. You ask yourself, do you have confidence as to whether the option will be exercised or not? So, for example, if you have high confidence that an option is going to be in the money or out of the money, it's going to have low extrinsic value. That's the relationship. High confidence that it's in the money or out of the money equals low extrinsic value.
And think
So,
of
for
extrinsic
example,
value as the premium you're paying.
That's the insurance policy. So let's go back now. These were shot a while ago, back when Home Depot was $180. And sometimes people think that I use these slides because I'm cherry picking it. I have some animations in it, and I've run some Black-Scholes models, and it can be a lot of work. Trust me, as soon as we get done with this, pull up the current platform, you're going to see that these relationships are going to hold just about the same. You're going to get roughly a 4-to-1 or maybe a 5-to-1, probably a 4-to-1 on Home Depot. But here's the point. Here's the stock trading at about 182. Let's say that we have a call option down here that the strike is, what is that, maybe about 150. That's a deep in the money call. Stock's at 182. So Stu, let's say this is a 30-day option. Do you have high confidence that this option will be in the money and exercised by somebody in 30 days?
I do.
I would too. That doesn't mean it's impossible to fall out of the money. Our
No.
best guess is that this is definitely going to be exercised. So think about that. If we have high confidence that this will become shares of stock, why would you pay a lot of money for the right to walk away? Well, you wouldn't.
I wouldn't.
Right. And that's
But
why
I would pay something.
I would pay something. But the further down the line that we go with the lower strike price, that's going to push those premiums smaller and smaller. Now let's go to the other
What
side.
I'm saying is it's a higher confidence. And why is it higher confidence? Because it's farther in the money.
So
It's
deep
got
in the
to
money.
Stop it farther the move.
Yeah, just unlikely. Let's go in the other direction. Let's say that this is the 220 strike. Stock is down here at, let's call it 180, 182. Stu, do you have high confidence in this one?
I have very
little
high
bit of a
confidence that it will be out of the money. Yeah.
Exactly. I ask that to people, and they usually get tripped up and they say, oh, no, I have no confidence in that. That's
Yeah.
not true. You do have high confidence.
So you got to look at what it currently is. Currently, it's an out of the money option. So do you
It's
have confidence
way out of the
in being
money.
out of the money option? Yeah, until it's not. But yeah,
So here's another way to look at it. I could say, Scotty, what's your best guess as to what this one's going to be, let's say in 30 days? In the money or out of the money?
In the money.
What's your best guesses about this one?
Out of the money.
Right. So why can he say that with so much confidence? See, he has confidence in those guesses. And because he has confidence, why would you pay a lot for the right to walk away up here when you pretty much know with 100% certainty that anybody who buys that option is going to be walking away from the deal?
and what that's translating to is, if everybody thinks about their matrix, is the farther you go out of the money, the less the dollars are that the option is going to be.
Right. It's a cheap insurance policy. Now let's go to the other side. Let's go to the current stock price. So Stu, let's say that we have a 182 strike, exactly at the
182
money.
strike. Yeah.
Do you have, is that going to be an in the money option or out of the money in 30 days?
I have no idea, Bill.
Scotty,
50-50 I would be
give it-
highly
yeah,
uncertain.
exactly.
Pretty much by
Very
saying
right
I
there
have
in the
no
middle. I'm gonna give it a
50-50 is
50-50 shot.
the 50-50 is the worst level of confidence you can have. And he's right.
I'm not leaning one way or the other.
I have no idea. So if you have no idea what's going to happen to the insurance policy there, that's why your at the money options have higher extrinsic values, not necessarily higher total prices, but higher extrinsic values, because that's really what the option is the extrinsic value. So let's go put this to the test. Here we got the stock was 182, and right here the 180, close enough to at the money, has an extrinsic value right here of $12.40. What happens to the extrinsic value as we go in this direction? We go 10, 8, 6, 5, 4. If we kept going up and up and up to lower strikes, we'd eventually hit 50 cents, 30 cents. They're getting less. Why? Because we're confident that these will become shares. And the lower the strike, the more confident we are, and therefore the less we're willing to pay for the right to walk away. But what happens if we go in this direction? Look at this. We go 11, 9, 7, 6, 4. Same thing. We're getting lower and lower insurance policies or extrinsic values because we have high confidence. In this case, high confidence that they're dogs with fleas. They're just not going to become in the money options.
Which is why they're cheaper the farther out you go. So those who like engage in the practice of let me shop at price that I can buy,
It's
you know,
bad
look,
idea.
I mean, you can do that, but you are changing your confidence level. You're changing your probability levels. You're changing a lot of different things that you may not be aware of.
very good point, because a lot of people think, hey, well, if the stock goes up, all options go up $1, so I might as well buy the cheapest one I can. That is absolutely not true. And that's how a lot of people buy their options. Let me go slide down until I find something that I can afford. Absolutely a horrifically bad idea to trade options. So right now, what you want to see is we're showing you with real numbers. As you move away from at the money, you are getting to cheaper and cheaper insurance policies. And the word is confidence that you want to watch. Okay, so with that, let's take a look at the...
Looks like they shot this like somewhere in COVID. That's the last time.
I think it was, yeah. But think that wasn't that long ago, and we've already more than or basically doubled.
And the big
so think about that.
It wasn't.
That's actually a good point. Think about that. If we had bought stock replacement and did 4-to-1 leverage, and we've basically doubled, it's not a bad return for a couple of years.
Yeah. Would you have made as much had you bought the stock outright? The answer to that is no.
No.
Would you have lost less had the stock continued to go down? The answer to that is yes.
Yeah. You bought stock with an insurance policy.
You bought
so
a hedge.
the stock replacement strategy simply says, let's look far enough in the money so that there's lots of intrinsic value and very little time value. And if we find that magic spot, the market will treat that call more like share, not perfectly, but more like shares of stock and less like an option. Mm-hmm. So now that brings us up to the magic question. How far in the money is enough? All right. And so what we're going to do here, first we have to visit our little ad here, marketrebellion.com/get started for some great training materials. Make sure that you get trusted sources when you are learning options. And that's a great place. Lots of free things for you, including videos. So let's take a look at this. Let's say that these are the only strikes we have. If we go to the highest strike on the board, which is 175, and I'm going to use the mark, which is the halfway point between the bid and the ask. I could pay 16.25 for that, but I could also pay 19.27 for the 170 strike. That's an increase. I would have to shell out, let's call it another $3.
Mm-hmm.
Why would I do that? Because I've reduced the insurance policy. I have more confidence that the 170 strike will be in the money compared to the 175. I can knock off almost $2 of the insurance. And if I'm trying to make it behave like stock, I'm definitely taking that deal. All right, let's do the next step. Let's do the same logic from 170. If I go from 19.27 to 22.50, I have to shell out an additional $3.23, but I'm knocking off $1.78. If I'm trying to make this
look what's going on here, everyone. Look, you're going 5 more points in the money. That means you got to buy $5 more of intrinsic value. and you get to knock off a whole bunch of extrinsic value, and the net difference is what you're going to pay.
Right.
Extra,
So now,
which is not going to be the full $5. It's going to be the full $5 minus the extrinsic values.
yep. So now let's take a look. What would happen if we continued this logic all the way up the chain? If we continue, we're going to eventually reach a spot where I could go from 56 to $60.72. I got to pay an extra $4.72, almost the difference in strikes. And yet, how much did I knock off of my insurance policy? 26 cents. See, the problem is you will eventually hit this point of diminishing returns where you're going to have to pay
absolutely.
5 to knock off 0. And if
What
you
am I
look,
getting for my extra money? Basically nothing.
right, you're just putting more intrinsic value that might be lost, and you're getting really no benefit for it. So that's why the stock replacement strategy says yes. Out of all of these strikes, the 120 strike behaves far more like shares of stock than any other strike on here. But now we start to lose some of our leverage. And it's a balancing act like a lot of strategies. And so what we want to do is this magic spot is somewhere in this 80 to 85 range.
Yeah.
And what's magic about it?
It's just a range, everyone. It's not like Bill saying magic. It's not like the number. It's not the magic number.
No.
It's not the one that's going to absolutely make it work. It's just a range to mimic the movement of the stock, to give you the upside that you're
Right.
looking for, without paying, a whole lot of added intrinsic value that is not really going to benefit you, and start at some point in a reasonable fashion on the downside to actually create the hedge that you're paying for.
Right.
That's the
what
balancing act.
what you're trying to do is to just find, I always call it the hunting ground. Just find the 85 delta. That's just roughly where you want to start looking.
Yeah,
You might end up at 92
you go with
deltas.
that.
You might end up at 75, but it's somewhere in that range. And the benefit is that you're going to get very high deltas, but you're basically controlling shares for a lot less money. And that's the stock replacement strategy. So let's take a look at it here. Let's do an example. We've got the 140 strike, 315 days to expiration. I'm just going to use round numbers. I'm going to call this $2 of extrinsic value. And I'm going to call this the mark $42. And I'm just going to do that to make the math easier. So let's say it's trading for 42 and we're paying $2 of an insurance policy. All right. So again, why is this insurance policy so cheap or relatively cheap? Because we're very deep in the money. The market's reasonably certain this will be an in-the-money option in 315 days. So they're not charging you a lot for the right to walk away. But it's also not zero. So they do recognize there is a chance, just not a very good one. Mm-hmm. So now let's go back to here. Is that an expensive option? $42. Well, remember, it's $40 of intrinsic and $2 of time. That's important. So if you buy the 140 call for the $42 premium or total price, you've paid $182, but you've got a $2 option. It is not a $42 option.
You could even say it's an option to walk away.
It's the option. The right to walk away is $2.
Just say you're paying $2 for an option. Well, what's the option to do? Well, it's the option to walk away if you choose to.
If you choose to.
Why would you choose to? Because the stock got bludgeoned because you were wrong.
Right. So if you have the right to pay $140 and the stock is at $182, there's a $42 immediate benefit in there. If I'm asking Stu to sell me that option for less than $42, I'll just buy it, I'll exercise it, I'll sell the stock, and I'll make free money. That's why you got to pay the $42 or the $40 of intrinsic value. That's just cash. That's got nothing at all to do with the option. This is the option. That's what you're paying for the right to walk away. All right. So let's go back and use this example. Stock's at 180, 140 call at $42.
Mm-hmm.
Stu buys the stock at 180. Scotty buys the 140 call. Stock falls all the way down to 140. Exactly the strike of Scotty's call option. Stu is down $40. Scotty is down 42. How much worse off is Scotty compared to Stu? 2. Where did the 2 come from? That was the extra money that Scotty paid for the right to walk away. He is
Yeah,
not
but he got to sleep at night and I didn't.
true, but also where traders look at this, they say, "Oh man, that was $42 for the option, and I lost 100% on my money. I should have
Ugh.
bought the stock." Not true.
Ugh.
If you bought the stock, you'd be down 40.
Right.
He's only $2 worse off. That's the option.
But that's not even the beauty of it. Keep going, Bill. I know where you're going here.
I know you know where I'm going, but now we've also talked about this before. You've heard us mention that calls or puts or calls, that they're all insurance policies. But now, Stu, where is the insurance policy? Because it looks to me like Scotty lost $42. Where's the insurance? Why did he pay that $2?
It's underneath. You can't see it.
Exactly.
You can't, look for things you can't see. I say that all the time on here. It's underneath 140.
It's if it goes below his strike.
Yeah.
All right. So let's find out where the insurance is, because this throws people, and it'll bring shed much more light on why you're paying the $2 for the insurance.
It's not even
policy.
in the fine print. It's in the strike price. All you got to do is read the strike price.
Right. So you can think of it like a deductible. You know, where does Scotty not want to hold the risk anymore? And if he said at 140, then that's this one way to understand the strike that he's picking. So let's say the stock falls to 130.
Uh-huh.
Now, Stu bought shares for 180. With the stock at 130, he's down $50 or 28%.
Ooh, 28%. Ew.
That's a pretty good hit. Now, Scotty bought the 140 call for $42.
Yeah.
And it expires worthless. He's down 100%. Now, again,
I want to be down to 28%.
That's what everybody thinks. They all say, I'm never buying options again. I got my head handed to me. If I'd have bought the stock, I'd be down only 28% and I could continue holding it. Not true. What do we have the right to do here, guys? 140 call. What can we do?
Walk away.
Well, no, but what can we always have the right to do? What? Exercise.
Again. Exercise. Take the shares.
If you're going to complain about it and you wish that you could have exercised, exercise it.
Yeah, go ahead. Why
So now
would you?
watch this. If you exercise,
You'll make a big mistake.
you'll pay 140 plus the 42. You have a 182 cost basis. You are down 52 instead of 50. We're right back to being down $2.
Oh, that's a good idea.
But let's look at this a little further. If the stock is 130, why would we exercise it and pay 140? We wouldn't. Instead, we'd walk away, buy the stock in the open market at 130. Does that mean I'm asking you to let the option expire worthless?
Yeah.
That is exactly
Absolutely.
right.
Yeah, because
It's an insurance policy.
Or not buy the stock, buy the 110s
or if you want to do stock replacement again. But what I'm trying to show here is that when people complain that my option lost, I lost 100%, I got my head handed to me. Watch this. Scotty can now that he sees where the horses are in the race, he can say, you know what, I still like this stock. Let me just go pay 130 for it. And he paid 42 for the option, so his total cost basis is 172. And he's down how much now? $42, right? The stock is 130. He's got a cost basis of 172. Well, he is down $42.
But the stock's down 50.
How much is Stu down? He's down 50. How did Scotty suddenly become $8 better off than Stu?
Because he had an insurance policy, Bill.
And where is that insurance policy? Here it is. Calls or puts, puts or calls.
Then the $2.
If he had the 140 put,
and -2.
if he had the 140 put with the stock at 130, what's the 140 put worth? 10.
$10.
How much did he pay for the option? 2, which means he has he would have an $8 profit. There's your $8. That's why Scotty is now $8 better off than Stu, because his insurance policy paid off $10 because he couldn't fall below 140. And with the stock at 130,
synthetics here, are we, Bill?
We in roundabout ways.
Sorry.
These are synthetics.
Sorry, man.
So the point to see here is that when you have that call option, it's an insurance policy. It's an insurance for the right to walk away if it falls below 140. When we set it up, it was a very low chance for that to happen. So no, you're not going to pay a lot for the insurance policy. But unfortunately, traders do that and they look at things in percentages and they go, I lost 100%. If I had bought the stock, I'd only be down 28%. And that is not true. You're down $2 worse than the stock trader. That's it.
Here's just something else I'll throw out there where people kind of think, and I run into this a lot. Well, it's not really a loss until I sell it.
Yeah.
I happen to 100% disagree with that. You may feel otherwise out there, right? That's really just an accounting term. Is it in the unrealized column or the realized column? Well,
still a loss.
You know, you're down $50. You're down $50. I don't care what the deal is. If you want to ride it back up and make your $50 back, yeah, you can do that. But you can do the same thing with a new option, even though the old one expired worthless.
That's right.
So why not have the insurance for a small fee?
That's right.
The fee that you pay,
get this leverage.
And get the leverage. So you know, you have to be able to look at all angles of it. It's not just a one and done discussion.
Right. So once we get done with this, check it for yourself. Go look at Home Depot, go deep, pick something a year out, 2 years out, pick your expiration, go deep and out, start around 85 delta, look at the extrinsic value. And if you don't like that extrinsic value, keep going to lower strikes and watch what happens. Eventually you can get it down to $3, $2, at whatever you want it to be. You are going to hit a wall with the cost of carry, but you can get it really, really small. And then look at and say, well, if I had to pay whatever that price is for the option versus the stock, divide those out. How much, if you're paying 1/5 the price, you're getting roughly 5-to-1 leverage. If you're paying 1/4 the price, you're getting 4-to-1 leverage.
Leverage kind of sometimes it has a bad connotation to it. You know, we all think of like 2008, 2009, like, oh, Lehman Brothers, you know, Merrill and, you know, 200 to 1. It's not that kind of leverage.
It's not.
This is different. This is good leverage.
It's because you're floating the strike price. In fact, you actually have less leverage. Leverage is usually defined by the rate of change. So if you buy the shares, you've got 100 delta. If you buy the deep in the money call, you got 85 delta. You have less sensitivity than shares of stock. Mm-hmm. The leverage comes from the fact that you don't have to fully pay for the shares.
Yeah.
And so now that was really kind of touching the surface of it. There's a lot of things to talk about with stock replacement and rolling, possibly doing some diagonals against it. But Scotty, I know you get a lot of coaching. Is this one that you show, especially for newer traders who might have come from a stock trading background?
Absolutely. And especially on stocks that are a bit more aggressive, high beta stocks that you want a limited loss on, where the unlimited loss in stock can certainly happen in a high beta stock.
Oh, yeah.
And that gives you that opportunity to limit your downside and still take advantage of a stock that has a lot of upside. And
spread that money around thinner, you know, and maybe take some of that money and buy some other stocks or buy some of the underlying, maybe if it does fall. There's so many different strategies you can do. And this just opens up the doors for a ton of strategies. So that's really the basics of the stock replacement strategy. We wanted to share that with you because we do use it a lot here at Market Rebellion. So now with that little brief background, let's visit our chalk talk. The stock's at 180, 140 call is 42. That sounds familiar. I think we just saw that example. Somebody says, man, that's an expensive option. What do y'all think now? Well, it's hardly an option at all. It's a $2 option. That's it. $40 is cash.
Cheap is, you know what? Really cheap.
It's cheap.
Super cheap.
It's not an option at all.
Yeah.
It is far more like shares of stock. And the way that I can tell that, I can take 140 plus 42, and that's pretty close to the current stock price of 182.
And for those of you that said true and kind of thought about what if it was 39? Is it still an expensive option? Right. And when you work that through, you know, I'll give you the answer. The answer is not only is it not an expensive option, they're actually paying you money to buy it. It's underwater. It's under parity. Even though it's $39, you know, $39 is $39. But what does it give you the right to do? Pay 140. What are you paying for it? 39. So 140 at 39 is 179, and you have the underlying asset trading at 180. Sounds like free money to me.
You'd never be able to buy that option for 39, even though it might sound like an expensive option. It's just cash.
Not these days.
It's just the cash. Yeah, it's just the cash. It's all it is. It's got nothing to do with the option. That's why it's important
on the register.
That's why it's important to be able to break an option down into intrinsic and extrinsic value. So when we start talking about the word option, forget about the intrinsic value. Just focus on the extrinsic. So we hope that helps. Scotty, any closing comments, or Stu?
The only other comment, it's a strategy that I think is a strategy that should be in the back of your pocket for times when the market has low volatility, or you're looking to trade a high price stock.
And what's our vol right now? What's the VIX right now?
12, 13.
You're not going to get much lower than that. Cheap, it's a perfect time for it. It's a perfect time for it.
Yeah, 1248 coming out today. It was actually up 29 today. Vols are super low. You could buy this insurance at, of course, every stock's going to be a little bit different, but the market as a whole, the insurance is very, very cheap.
Yeah, and check it out on SPY. You do the same thing that we just showed you here for Home Depot. Go look at SPY. If you're not real comfortable with investing and picking stocks, pick the SPY, do stock replacement. You're going to get 4-to-1 leverage. You'll pay very little for an insurance policy, and you're going to get tons and tons of benefits. And so that's the stock.
Go ahead.
Okay.
The only thing that I would add here is that you may not want to see when you buy the contract delivers 100 shares. So it's going to act as a percentage of the $1 movement, and it's going to be on 100 shares. There are plenty of times when you may not really want to buy 100 shares. So
that's a good point.
You do, just buy a piece, buy 10 shares, buy 1 share, at some point, and you're going to slice in anyway. I mean, you're not going to buy a whole 100 shares at one time. You're never going to do that. You're going to just buy pieces of it. And when you get up to around, 80, 90, 100 shares, flip it into one of these, and then
that's another great use of it. Yep. Nobody says you have to buy the stock replacement up front. You can piecemeal your way into it. So with that, I think that's probably a pretty good stopping point. We hope that it gave you some really nice insights into really a strategy that I think is underused. And it's a lot of the things that we like to teach here at Market Rebellion. So please give us a call if you're looking for coaching. You can sign up with these guys right here, either Stu or Scotty. Scotty, thanks for taking time out of your busy day and joining us again today. Always great having you here. Stu,
thanks for having me, Bill.
Always great having you here. And we'll see you next. Actually, are we on next Thursday? We have to find out.
I think we are.
I think we're on the next Thursday. It'll be the next one that will be off. So we'll look for you next Thursday, and we'll see you then.
All right. Take care, everyone.
See you guys.